Hello, welcome back. I'm David with Ag Economic Insights, joining you for another Chart of the Week update. This week, we're talking about alternative lease payments. We're putting this in the framework of the landowner. Think about what type of lease payments might you be thinking about and receiving under alternative lease agreements. We'll have the link to the full article in the descriptions below, but the idea here is that cash rent, that's pretty predominant, especially through most parts of the Corn Belt, but there are alternatives. There's a flex bonus lease agreement, there's a crop share lease agreement. Crop share has a little more popularity in the Great Plains, specifically in Kansas, but the idea here is to step back and think about, what does the rent structure look like? They all have pros and cons, and it's really finding which one works best for you. And sometimes that is the amount of risk and return you're willing to take. But on other cases, it's really going to help you think about, the certainty of the payments, or maybe it's around the ease of negotiating the contracts, or how much complexity you want to take on as in the terms of management. So this chart takes a look at historic payments of the lease payments. If you go back to 2010, and you can see a couple observations here. When we had a pretty strong farm economy, we had higher flex bonus and higher crop share payments. So that income would have been higher under that type of agreement. Then we had a slowdown in the farm economy, and you can see that cash rents actually came up, and they were giving you the highest payment. There's a pretty big gap back in here. And then, of course, when we saw net income and commodity prices jump again around 2020 into 2022, we had really big flex payments, really big crop share payments, and cash rents lagged until more recently, 2023, 2024. So that driver's seat conversation switched a little bit. And so it's this risk reward trade-off that I think is really, really important. One of the things you should really keep an eye on here is take a look at how long some of these trends play out. So if you just look at a few years of observations, you're going to start to jump to conclusions that maybe one of them is vastly preferred, or one of them is inferior, but it could take several years for these reversal of fortunes to play out. We have more content articles in here. We took a look at the average rent and took a look at the variability or the variation in those annual payments, and you see that there's less variability with cash rents, more with share crop. But one of the ideas I really want to point out here is this cash rent. When we take a look at the cash rent, when you're thinking about this from the landowner's perspective, it has a lower average. And of course, that average is going to impact by the combination of boom and lean years that we have in the farm economy. This is 2010 to 2024. So it had the lowest average. But if you take a look at the max and the min, you could get a range, an idea of the range of possible outcomes. If you move down to, say, crop share, I think this is one of the challenges that crop share has. It had the highest average, it had the highest max, but also the lowest min. That gets back to that risk return payoff. Of course, there's also maybe some expenses that producers have to, landowners have to pay in that situation as well. But again, this is just an idea we want to share, get some thoughts going on, especially as rental negotiations might be coming up. Producers might be thinking about and talking about how can we get a rental agreement that matches the current farm economy, the current farm outlook. And maybe one of the questions, maybe the conversations can focus around the type of lease agreement that both parties are entering. That's all we have for this week. Until next time, stay curious.